And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to Tuesday. That's right, it is the day before Thanksgiving. I mean, we're just counting right down to it here.
You're keeping up with this.
Exactly. I'm all over this.
Yeah.
So anyway, welcome. It is Tuesday. Get by our website, realinvestmentadvice.com. Our Technically Speaking post out is out this morning talking about really this kind of, this exuberance in the market that we're seeing right now. No matter really kind of where you look at the moment in terms of extensions in the markets, deviations from long-term trends, overbought conditions, exuberance by investors, money flows, etc., all are hitting very, very high levels and levels that are normally historically seen prior to a short-term correction. It hasn't happened yet, and today we're going to see a little bit of an uptick because President Trump yesterday announced that he's going to allow the transition of the Biden team to start. That's good news. Gets the process started, get us moving back in that direction. And Biden has started announcing picks, and of course, one of his picks that we'll discuss this morning with Michael Lebowitz, CFA, is of course Janet Yellen for Treasury Secretary. This is the equivalent of letting the hen back in the fox house, or the fox back in the hen house, I should say. In her case, maybe it is the hen. So. She is known as a dove. So there you go. But anyway, we'll talk some more about that, the implications of that, obviously, going forward, because it has a lot to do with economic growth and prosperity down the road, and you may not actually like the results that you get. But I did want to talk a little bit about the markets here for a moment because, again, we've been talking about this idea that, look, holiday week is a very short trading week this week. Nobody's around. And so you get a lot of extra volatility during these type of weeks. And generally, the few days leading up to Thanksgiving tend to be positive for markets. And we've seen that so far. Yesterday's activity really wasn't much. We actually kind of closed about where we opened, even though the market was up yesterday slightly at the close. We actually closed about right where we opened. So we really didn't make any progress yesterday in terms of the market. We'll be up a little bit today. The question will be whether or not we can hold on to those gains during the day. But again, this week tends to be positively biased because, again, the inmates are running the asylum. All the professional traders are gone for the holidays. Coming back next week, once we get past Thanksgiving, we now start talking about mutual funds having to distribute capital gains. They have no cash. And we've got pension fund rebalancing for the year end coming up. And that's going to be roughly around $100 billion, maybe a little bit more in terms of dollars having to be rebalanced there. So definitely some pressure coming for stocks. And particularly because we've got a lot of stocks with a lot of gains in them this year, we could definitely see some more pressure on markets as gains are taking in and those profits being locked in at lower tax rates, particularly if the Biden administration does raise tax rates next year. You might see some, and that if there's a concern of that, you might see some additional profit taking this year. But again, right now, not a lot going on to be concerned about, but I did want to show you a couple of things here very quickly. Whenever the market begins this kind of consolidation process, as we've been seeing right here, where we get this kind of tighter and tighter range of price movement within the market, and that kind of consolidation is tied into our money flow sell signal that we talk about quite often here. Generally, you get more downside pressure in stock. And again, that doesn't mean necessarily that markets have to go down. They can just kind of go sideways here and consolidate gains for a couple of weeks or a little bit more and work that overbought condition off. But normally when you get this type of action, you wind up getting some downside pressure. In fact, the last time that we saw this type of action was here back in really kind of this late October, and that broke to the downside in concert with that money flow sell signal again. And we saw it again back over here where we had this consolidation beginning in September, and then finally we broke down with that as the money flow sell signal worked itself off. So again, we kind of have the same repeatable pattern here over the last several months. And again, not saying that we're necessarily going to break down and have a big correction, but when you've got everybody very exuberant, kind of everybody on one side of the cart, which is where we are right now, and that's really kind of the context of our analysis today in our Technically Speaking post, is that you have basically all the fuel set up here for a short-term correction. And again, look, I'm not talking about a crash. I'm just talking about a short-term correction, 3, 5, 7, 9%, something like that, well within the normal confines of market corrections during the year. And particularly after you've had such a big run here in recent weeks, a correction would not be surprising. But again, when you have everybody kind of on one side of the boat, that's the fuel, right? And what you need is some type of catalyst to light that correction. As long as there's no catalyst, everything is kind of fine. Markets can kind of just chop around and do their own thing. But again, something that initiates selling pressure on the markets can certainly exacerbate that decline when you have everybody kind of on one side of the boat. There's really no buying pressure at this point because everybody that was going to be buying has bought in. No matter kind of what indicator you look at the moment, we've got record low cash levels, you've got record positioning really kind of across the board, and you've got right now a lot of investors chasing extremely overvalued extended companies, base materials, industrial, small cap, mid cap, emerging markets. These are all very, very extended. We're talking about indexes that are trading at 4 and 5 standard deviations above means, and that's simply a situation that can't last for very long. You're ultimately going to get a correction. Again, all that is needed is some type of catalyst to cause that correction to begin. So the point here is simply don't be pessimistic, but just, this is where you kind of take a look at your portfolio, take a little profit out of positions you've made a lot of money in, trim up positions that aren't working. If they aren't working in this market, they're not going to work, period. So this is a good idea, time to come take some of those off the table. And positions you've been trapped in for a long time, great time to take some profits, get out of those positions and look to reallocate money elsewhere. So again, just kind of paying attention to really what markets are doing. Now, one other thing here as we kind of continue to talk about this, and again, as we've been discussing here over the last couple of weeks, bonds have been performing a lot better here as of late. We've had a nice pickup. They held their ground yesterday above the 50-day moving average. And again, we've got positioning back in bonds starting to pick up here as we move into next year. One of the concerns here, of course, is that you do get some type of weaker economic growth because of lack of stimulus and lack of input. But this is kind of an interesting dichotomy here that we're running into. So as we move into next year, there's no stimulus at the moment. And there's certainly a lot of hope that we're going to get more stimulus. But at the same time, the economy's not doing terrible. So do we really need to go into, another $1 trillion or $2 trillion of debt to do a stimulus program when the economy is not actually doing all that terrible? Now, this is one of the things that we'll discuss about Janet Yellen this morning. She's very much on board with doing a whole lot of expenditures. So, this is going to be an issue down the road that we have to start addressing here. What bonds are telling you is that there is a demand for Treasury and for safety and risk. Despite a surging market here, there is not this big overwhelming concern about inflationary pressures at this point, because if there was, bonds would be selling off dramatically here, but they're not. And we're actually seeing some recovery in that. So there is a demand in the short term for safety and for income. And of course, this also goes along with the dollar. The dollar had a big day yesterday, big spike here. And we may actually have continued to kind of watch this bottom forming in the dollar. And we're just about to trigger a money flow buy signal on the dollar, which should suggest a much stronger rally in the dollar. That would also coincide with a correction in the market as well as more inflows into bonds. So kind of really pay attention to the dollar. It'll tell us a lot here over the next few days about what risk positioning is really looking like as we head into the end of the year. I'm your host, Lance Roberts. We'll be back, pick up here in a moment with Michael Lebowitz, CFA. We'll talk about Janet Yellen and the flight of the dove. Don't go away.
It's what it takes. You can't sleep, you can't eat, just go down. You're empty, your throat is tight, you can't breathe. Another kiss, wish all you need. You like to think that you're in need.
You're listening to The Real Investment Show.
Long-term care is the financial elephant in the room. The median national cost of a private room in a nursing home? $8,517 a month. Are your finances prepared to handle that burden? Our next Candid Coffee with Richard Rosso and Danny Ratliff can show you how to protect your finances from the effects of a long-term care event, the myths to ignore, and how to prepare a plan to address the cost. Register for the special long-term care edition of Candid Coffee, Saturday, December 5th at riaadvisors.com.
Life is a series of events. How long will your retirement last? More importantly, how long will your retirement funds last? You can plan for a successful retirement with RIA Advisors' free financial planning tool, MyBlocks. It's our online modular manager for your money and your life. Does your vision of retirement match up to reality? MyBlocks can help to determine how much you'll need and how to achieve that goal. Create your own personal financial vision for the next decade with MyBlocks, our free tool at riaadvisors.com. That's riaadvisors.com.
The Real Investment Show.
So this morning at 6:17, that was the absolutely wrong intro music for this segment, Brent. It should have been When Doves Fly by Prince.
I'll see if I can find that.
So we talk about Janet Yellen.
I sort of like it. Are you going to go my way?
Yeah, this is true. So a couple of things I was just talking about here at the open is, of course, Donald Trump has done two things here. One is that he's now, announced that he will allow the transition to occur. And, of course, with that announcement, we saw a lot of picks coming out from the Biden administration. One of those in particular of most concern to us in the financial markets was the pick for Treasury, and that was Janet Yellen, who was the former Fed chairman prior to Jerome Powell back in 2014, 15, and 16. This has a lot of implications, obviously, and I thought it was interesting because the headline this morning is Market Cheers the Pick of Janet Yellen because she'll focus on fixing the economy. That's not the job of the Treasury. So the job of the Treasury is to make sure that when the government needs to fund deficit spending, which we have plenty of, that they basically issue the debt and make sure it's sold off to the primary dealers, which there's 20 primary dealers in the world that buy the treasuries. Those treasuries are then sold to, in theory, investors from those primary dealers. Now, we broke that system about 5, 6, 7, 8, 9, 10 years ago when the Federal Reserve started buying the debt from the primary dealers. So Treasury would issue the debt and it would go to the primary dealers, aka Goldman Sachs, JP Morgan, etc. It would get aged there for a period of a couple of months. And then the Treasury, the Federal Reserve would announce, hey, we're buying QSIP number whatever. And then the Reserve Bank would sell that bond to the Fed. The Fed would credit their excess reserve account, and voila, you have QE. Now, lately, that whole process has gotten down to the matter of days. As soon as the Treasury issues the debt is bought by the Fed within 2 to 3 to 4 days. It's been a very quick turnaround. That's really the job of the Treasury. It's not fixing the economy. But that's what the market thinks her job will be, because now she will interlock herself with Jerome Powell or whoever the Fed chairman is going to be under the Biden administration to do more QE, more stimulus, more support for the economy. But that really hasn't worked all that well for the economy, has it, Mike?
No, but, let's go back. Look who the two names were to take the Treasury Secretary seat. Mm-hmm. It was originally Warren.
Right.
And then I think
Wall Street threw up on that one.
Exactly. But for many reasons, not just because she hates Wall Street. I think because she's not from the Fed.
Right.
So when it came down to the last couple of weeks, it was either Janet Yellen or Lael Brainerd, and I'm butchering her name. I apologize.
Lael.
But but she is from the Fed as well.
Right.
And this.
And by the way, Lael Brainerd was a worse choice than Janet Yellen.
I don't know. The bottom line is they're putting in probably the most qualified person in the world that understands the Fed.
Right.
Not the most qualified potential Treasury Secretary, nothing against Janet, but Janet Yellen, other than maybe Ben Bernanke and Powell, who's sitting in that seat right now, understand the Fed better than anyone else.
Sure.
So it's not just a coincidence, right? This is 20 years. This marriage is 20 years in the making. At first, it started where the Fed would just lower rates because the Treasury had a decent amount of bonds to issue, and they would make it a little bit easier on them, cut their interest expense. And in 2008, they started dating, the Fed and the Treasury, right?
Right.
Started dating, where now the Fed says, okay, we're going to buy your bonds, and we're going to do it under QE, so it's all on the up and up, and everyone can see it. And now what we're seeing, I'm afraid, and then that was put on steroids during the last 9 months.
Right.
And remember, again, QE started before COVID.
Right. Well, no, and that's right. So, and so, kind of the way this relationship worked, and to your point is they were kind of on Tinder, post the financial crisis, and they would date every now and then. Right. And then somebody got knocked up, and now they're married. They're being forced to get married here because of the COVID. So yeah, that's how this. So it's a shotgun wedding. Is what we've got going on here.
And Janet Yellen's first words out of her mouth, I saw it this morning from CNBC. Worse than I'm pregnant. It's that Congress should reconsider letting us buy stocks. Right. Now's not the time, but they need to reconsider it.
Yeah.
Basically, the Federal Reserve will be setting fiscal policy. That's essentially what's going on in the long run. The Federal Reserve, who is owned by the banks, are now basically in a place or will be in a place where they potentially are setting fiscal policy. Right? Mm-hmm. What have they been doing for the last 6 months? Every time one of them gets on stage, they yammer about the need for more fiscal stimulus.
Right.
They talk about the intricacies of fiscal stimulus. They run fiscal stimulus programs with the Treasury. Some of these joint funding programs are run together. So now we have a Federal Reserve that will be running or managing, sitting at the table of the fiscal policy decisions. Nowhere in the Federal Reserve Act does it say anything to that effect.
Well, and look, and reality is that with the current administration coming in, it's very likely that Congress will go along with Janet Yellen. They'll take her lead, and they'll certainly approve the charter to allow them to buy, make direct purchases of stocks. People are going, well, they've been doing that already. No, they haven't, because all they can do is really make loans, right? This was the whole reason for the Main Street Lending Credit Facility, the PPP program. They can make loans, but what this would change the dynamic to is they could actually go in and actually buy stocks. Now, that's an interesting, dynamic here, because the belief is, and this is from Ben Bernanke directly in 2010, if we elevate stock prices through QE programs, that will inspire confidence of consumers to go out and buy stuff and generate economic growth. The problem is it never worked that way. We went from a market that was widely owned by individuals across the country to now a market that's owned by the top 10% of income earners and shrinking rapidly. And we've seen countries that have gone into the business of buying equities directly, and it really hasn't worked well for their country at all, aka Japan.
Right.
So it's interesting that we're doing more and more of the same thing to help boost the stock market. It certainly benefits Wall Street, but it doesn't benefit the vast majority of Main Street America.
Right. But who buys elections, right? We've talked about this before. Exactly. Who buys elections? It's the wealthy, right? And the wealthy want to see stock prices going up. That's what makes them wealthy, right? But it's the other 90% of us that don't have a lot of stocks, and the stocks we have are in 401ks that we can't touch. Mm-hmm. And you're right. This has been going on. This has been going on for 40 years, right? This has been going on since the Reagan era, trickle-down economics. It doesn't trickle down. Right. It's actually a pretty pathetic policy, and Japan is evidence of that. And we're heading down the same path as Japan, as Europe, and this is just another step closer to what's going to end up being a very poor, what is a poor experiment, and is going to backfire severely on this country. Now, it doesn't mean the stock market won't go to S&P won't go to 10,000. Right. Maybe it will, and then we can all cheer from our little shelters. But
well, no, and that's kind of the point. I mean, you take a look at Europe right now, right? the amount of negative yielding debt just hit an all-time record, right? Economic growth remains very nascent at best. Wealth inequality continues to expand. We see the same thing in the United States here. Interest rates are low, inflation rates are low, can't get really economic growth. And we've talked about this at numerous times here coming out of this financial crisis. As the economy recovers, it'll recover to a slower rate of growth on a trend basis than what we saw prior to the financial crisis, which was slower than it was prior to the dot-com. So, we continue down the same path, getting worse and worse results, but we keep doing the exact same thing because the idea is that as long as the stock market goes up, that's great. Now look, for us, that's fine, right? We just have to be long stocks and we'll all make money and it'll be fine. The problem is that you've also got to have production within the economy, and these policies actually ultimately erode that capability to increase productive activity within the economy.
Right. If you go back and look at the last 30 years of what's happened, the productive growth of this country has been in decline. Productivity is still rising, but the growth of productivity has been in decline, and the amount of debt we're taking on has been increasing. And there are two lines like that. Right. And that's not the sign of a healthy economy. So the question is, why are they still doing the same things that are creating that?
Well, because apparently if you do more of the same thing, you'll eventually get a different result.
Right. Because
that's the belief anyway.
Right. Because the problem is those that are paying for this grand experiment win. Right. And they continue to stay in power.
Well, and that is the thing. But I guess the question is when do people actually start asking for something different? I mean, obviously
they are.
Well,
they are.
That's
what these social eruptions are. At the end of the day, these are economic based.
Right, but they just elected the same type of people to the presidency that they had, the establishment kind of politicians that aren't going to make those changes. Right, we're going to keep doing the same thing to make things worse, and we keep electing the same individuals.
And in 6 months, we're going to see those social unrest pop up again, because at the end of the day, they were economic based. I mean, they were incited by many different causes, police brutality being one of them, as they should have. But look, at the end of the day, this is economic based, and everything that's being done to get through this pandemic is destroying our future economy, and it's going to only make the social unrest worse, not better.
Right. So I guess that's the real question here, and when we come back, from the break, we'll get a little bit more into this. But, talking about, it certainly seems that within the stock market right now, it's a no-lose situation, right? Just buy stocks, they go up. There's nothing really to worry about. In fact, the more risk that you take, the better off you are. I mean, we're watching a huge number of companies that are being chased that have absolutely no fundamentals, but you can make a lot of money with them. When and if does that ever go wrong in this type of a scenario? We'll talk about that with Michael Lebowitz when we come back from the break. Don't go away. I'm your host, Lance Roberts. Get by the website, realinvestmentadvice.com. Our Technically Speaking post is up and running called Everybody's All In Without a Net. Be right back.
Anytime at realinvestmentadvice.com.
Long-term care is the financial elephant in the room. The median national cost of a private room in a nursing home? $8,517 a month. Are your finances prepared to handle that burden? Our next Candid Coffee with Richard Rosso and Danny Ratliff can show you how to protect your finances from the effects of a long-term care event, the myths to ignore, and how to prepare a plan to address the cost. Register for the special long-term care edition of Candid Coffee, Saturday, December 5th at riaadvisors.com.
Got questions for Lance later? Ask now at realinvestmentadvice.com.
And welcome back to the show this morning. I'm your host, Lance Roberts. Michael Lebowitz, CFA, joining me as well. Talk a little bit about the Janet Yellen pick as Treasury Secretary. What does that mean? And again, we kind of went through that. And here's the interesting kind of dynamic about this is that, there's a lot of conversation here lately about economists. Oh, we need more stimulus. But actually, the economy's not doing too bad, right? Services PMI from market just hit a new high yesterday. Manufacturing PMIs are hitting new highs. Employment's been recovering to a degree. Are we back to full employment? No, we're not, but it's certainly recovering here. And we're seeing people going back to traveling, eating out. We saw over 1 million flyers over the weekends. People are getting back to living, right? I mean, they're going back to doing what they're going to do. And a lot of hope here is that, if we get a vaccine, well, that's just going to unleash this huge amount of pent-up demand that people have because they've been sitting at home on all this, savings that they've got because they haven't been spending any money. But the reality is that's not true at all. We saw, right after the pandemic, of course, massive amount, we saw $1,200 checks to households. We saw extended unemployment benefits. It gave people up to $600 more a week than they were making even when they were working. All that money's been spent. So whatever pent-up demand there might have been, right, from having a recession and a shutdown, we actually fueled a pull forward consumption in the economy, which leaves now this gap to fill in the future when we get there because of just there being a lack of that stimulus. So there's likely not this big pent-up demand that's there. But the stock market, as I was talking about a second ago, the stock market is right now, by any measure, extremely overvalued. And we took a look at what we're paying for cash flow and paying for earnings. We're paying an exorbitant amount in terms of valuations for stocks. A lot of companies are what we call zombie companies. They only exist because they can take on cheap debt. And in a lot of cases, companies are actually generating lower rates of revenue growth, but are trading at really astronomical valuations. And of course, there's just a tremendous amount of speculation in the markets. People are chasing, green energy companies and a lot of other assets that really have no real value to the company, but they're buying it just in the hopes and because of the fact that they're just going up. So lots of speculation in the markets, high valuations, lots of bullish sentiment. Mike, doesn't seem like anything here can really go wrong. I mean, valuations are kind of passé. Nobody cares anymore.
Right. It's become a casino, right? I mean, that's what the stock market is slowly becoming. It's a casino where people are betting. They're not investing. Investing is about growing your wealth over long periods of time. Betting, speculating, trading is about making quick short-term gains, or that's the stated goal at least, right?
Right.
And if your goal is to make money today, you don't care about fundamentals. You don't even really care about technicals. All you care is that what you buy today goes up throughout the day and you sell it, right? Your holding period is hours, minutes, maybe a day or two. Right? So any of the underlying concerns that one should have about stocks, especially at these levels, because we're approaching levels that have, we've gone past 1929, and now we're only talking about some valuations from the late 1990s, right? The tech boom. So, the question I think you have to ask yourself is, are you a gambler or are you an investor? And the honest answer, I think, is that we have to be a little bit of both, right? And it's scary, right?
Right.
But long-term investors understand what's going on, and they should be scared of the market, frankly, scared of what's going on, because every time we've been at these kind of valuations, there have been major corrections. But what's going on with the government, with the spending, with the Federal Reserve just continue to keep their foot on the gas pedal, tells you that there's a lot of liquidity. That money is not going into the economy. It's not being invested. It has nowhere else to go. And stock prices can keep going higher. Even though they're egregious, they can be more egregious tomorrow. And those that are in place to short the market are long gone. They've been taken out on stretchers, right? So there's no police for this market.
Right.
Right? No one's shorting this thing. No one is telling you to be worried. There's nothing to be worried about here, right? Who's out there voicing any concern?
Well, and that's kind of the point here is that, the last time we saw, this type of record inflows into markets, and over the last few weeks, we've had record inflows into equity markets. And last time we saw this was in December of 2017. And this is when we were passing the Tax Cut and Jobs Act under Donald Trump and lowering the tax rate. And everybody was trying to rush into the markets to get ahead of lower tax rates, which meant higher corporate profitability, higher corporate earnings, wanted to get ahead of that valuation adjustment. And of course, 2 months later, February, we had a 20% decline in the market. So you're seeing the exact same kind of input into the market currently, this kind of wild, reckless abandon. But I guess one of the questions is where, not only are there no short, people shorting the market. And again, as you said, they're kind of like the police that, people that short the market, they actually provide a service by providing the other side of the trade, right? And right now, they're not shorting the market. So you have really a lack of sellers, and we're getting to the point to even have a lack of buyers because there's only so much money being available to put into the market. The average person, in the country, 80% of Americans have less than $500 in the bank. They're not the ones buying the market. So where's all this liquidity coming from?
But think about that, Lance, for a second. Like, that's a very important point you made, right? Mm-hmm. Lack of sellers. Potentially, we're getting to the point where there's a lack of buyers, right?
Right.
What is liquidity? Liquidity, when you have a lot of liquidity, that means you have ample buyers and ample sellers. So that when stock prices move, there's a lot of buyers and a lot of sellers. So stock prices are gradual. They can trend up, they can trend down, but they tend to be very gradual because there's a lot of players involved to help regulate that price.
Right.
Right. Now what you're saying, and I'm on board, is that who else is going to buy that hasn't bought? Right. That number's coming down quickly. There still are potential buyers. Right. Mm-hmm. And who's selling? There are none. So what we end up with is a potentially very dangerous market. Right. Again, doesn't mean it may not go up. S&P may not go up 1,000 points, but it can also drop 1,000 points. Whereas when we were talking about normal moves a year ago, we may have been talking about, well, the S&P may go up or down 50,
right,
75. You're amplifying the potential volatility because there is no liquidity. And we see this with the gaps in the market. Right. All of a sudden, the market will just shoot up 0.5% in minutes on next to no news. That's illiquidity.
Right. Well, and to explain this, I guess, so people understand, is that in order for there to, people hear this kind of, Wall Street wisdom from time to time, is for every buyer, there's a seller. And which is absolutely true. In order to have a transaction, you have to have somebody willing to buy and somebody willing to sell at a given price. The problem comes, as you're talking about, the reason there's this liquidity issue is that when you don't have anybody selling and everybody's buying, at some point, if there's a catalyst, right, some type of event, right, and these catalysts, these events are things that we don't even know what they are. I mean, we can, like in today's Technically Speaking post on our website, we lay out a laundry list of potential events. It will be none of those. I can tell you that, because the one thing that shows up that gets the market is a thing like a pandemic. Nobody counted on a pandemic and shutting down the economy, right? That wasn't even on the radar. That's the way it always is. But the problem becomes is that when that event occurs, sellers that were vacant to start with completely evaporate. They're not, they're not willing to buy at that point. And so everybody that's been long stocks, they try to start selling. And when they try to start selling, there's nobody there to buy. And there's some guys way down the list somewhere say, yeah, when you get down to my price level, I'll buy that from you. But that could be 10 or 15 or 20 or say 35% lower, as we saw in March, before those buyers start stepping in, in force. And that's where investors really get caught up here. They don't realize that a lot of the speculative investments they're making have huge downside risk because there's nobody willing to buy that stock until it drops a lot.
Right. And I think a lot of people say it doesn't matter. The Fed has my back. And maybe they're right. Mm-hmm. But the Fed, right now at least, does not buy stocks. Right. The Fed is the rah-rah cheerleader that gets everyone playing hard and buying and all that. But at the end of the day, the Fed may not be there, right? At some point, the Fed will be there, and they will buy stocks, and they will prop this up. They will prop it up. But the Fed does not buy stocks, and they buy bonds, but there are only so many bonds to buy because they're taking all those bonds.
Right. Well, look, this is the same problem that Japan has run into. It's a great idea that the Fed will buy stocks. But eventually, at some point, everybody just starts selling all their stocks to the Fed. And the problem becomes is that you begin to distort markets, because when the Fed owns 80% of the stock market, like Japan owns 80% of the ETF market, you don't really have a market anymore.
Right.
And so then this becomes a lot more difficult and then what happens? I mean, eventually the Fed has got to sell to somebody. And if they want to reduce the amount of equities on their book, right, they've got to sell to somebody. If nobody's willing to stand there and buy from the Fed, well, if you're selling and you're the sole proper upper of the market and you're wanting to sell, I'm not buying, right?
Right.
So there's and it may be years before you get there, but there seems to be a huge problem with this whole theory.
Right. One of the main principles of capitalism is free markets, and we are erasing a huge part of capitalism. And with that, the benefits of capitalism go away.
All right, be right back after the break. Got a couple other topics to get into real quick with Mike Lebowitz as we wrap up today's edition of the pre-Thanksgiving show. Don't go away.
And the words are really clear, so beat it, just beat it. You better run, you better do what you can. Don't wanna see no blood, don't be a macho man. You wanna be tough, better do what you can, so beat it. But you wanna be bad, just beat it. No one wants to be defeated. Showing out lucky, strong is your fight.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Long-term care is the financial elephant in the room. The median national cost of a private room in a nursing home? $8,517 a month. Are your finances prepared to handle that burden? Our next Candid Coffee with Richard Rosso and Danny Ratliff can show you how to protect your finances from the effects of a long-term care event, the myths to ignore, and how to prepare a plan to address the cost. Register for the special long-term care edition of Candid Coffee, Saturday, December 5th at riaadvisors.com.
You're listening to The Real Investment Show.
Come and shake your body, baby, to the conga. No, you can't control yourself any longer. Come and shake your body, baby, to the conga. No, you can't control yourself any longer.
And welcome back to the show this morning. It is 6:47. Michael Lebowitz joining us this morning, CFA. Let's switch gears here a little bit. Yesterday, the dollar had a huge rally. For the dollar, it was a big rally. Dollars don't really rally all that much in a day, and it was a huge rally for the dollar yesterday, which has a couple of potential impacts here. One, a strong dollar rally is not good for international and emerging markets, and a strong dollar rally ultimately is not good for commodity prices. Didn't really seem to kind of affect anything yesterday, but it was an interesting rebound off support yesterday for the dollar, really kind of driven by some of this other news that's going on. And again, this idea of maybe, Janet Yellen as Treasury Secretary might be, kind of a tailwind for the dollar. Stronger economic growth, better Fed policy in the United States. Of course, we have higher Treasury yields than a big chunk of the rest of the world. Certainly makes our dollar and our Treasury bonds much more attractive in terms of storing reserves. Your thoughts?
Right. Well, I think you said earlier, the number of negative yielding bonds in this world is now at an all-time high. Mm-hmm. So even though our bonds yield 0.5%, maybe 1%, if you want to take on enough risk, that's a lot better than a negative number, right? So that incentive to buy U.S. bonds you need U.S. dollars to buy U.S. bonds is always there. And as we see more and more bonds in Europe and Japan slipping into the negative territory, investors are like, we can't keep doing this. We can't buy negative bonds. We got to buy positive bonds, and they're buying them. Right. And it's the dollar's a funny thing. We were talking about this yesterday, Lance, that the dollar was sitting when we first talked first thing in the morning, the dollar was sitting on support, right? If it broke that level, it could start looking pretty ugly for the dollar. And from that point on, the dollar started rallying throughout the day, right? So I think there's also a lot of vested people. These are central banks, these are treasuries that are watching the dollar closely, and they do not want to see it break lower, right? Europe cannot afford for the euro to keep going higher. Same with Japan, same with these other countries in recovery, right? So they can use a little bit of strength in the dollar right now to help their economies to help their exports.
Well, it's interesting though, but it is a tailwind, in some regards, but it's also a headwind in others because again, higher dollars, all commodities trade in dollars. So if the dollar goes up in value, that makes commodities more expensive to foreign importers of our exports, right? More expensive for them. So it has some negative effects on a global basis as well. But it was interesting when you were talking about negative yields that there's a belief that the United States can't at this currently have negative yields, but we actually can. It's just a function of people buying bonds to the point that they run the price of the bond up until it has a negative yield to maturity on it. And so we're not that far away from actually falling into negative yields here as well.
First of all, we do have negative yields.
On an inflation-adjusted basis, yes.
Right. Because at the end of the day, we're all subject to inflation. So if inflation's running 2% and the bond yields 1%, guess what? You're losing 1% a year.
Correct.
Just like if your salary, if you got a 1% raise in a 2% inflation environment, you're actually making less money this year than last year. Right? So we do have negative real rates.
Yeah, but I live nominal. If I get a 1% raise, I'm happy.
Right. Even though it costs you 2% to do everything
exactly. You were doing. But it doesn't matter. Quit taking away my happy face.
So you're right. But Lance, I think the question you're asking is, are we going to have negative rates here?
Yep.
And I think it's just a question of time because the amount of debt has just grown another, $8 trillion?
Right.
Between corporations and the government. And that debt has to be serviced and funded and paid for, and new debt has to be issued to fund the old debt, which is constantly rolling over. A lot of that debt is borrowed in 3-month, 6-month increments, and that it always has to be rolled over. So higher interest rates is not really an option for this country. And as you add on more and more debt, interest rates at the same level are not an option for this country. They have to be lower. And we're eventually going to end up in the same trap as, good chunks of the rest of the world, where interest rates will be negative.
Well, and again, this is one of the, the things that is also important to understand is that we're taking on more and more and more debt simply to fund, existing debt and to continue operations. And I keep having to refinance my debt at lower rates in order to try to keep staying in business. This is what we call zombie companies. And currently we have a tremendous amount of companies that are in that category. And they mostly fall in that small to mid cap space that everybody's chasing right now. So, people are buying stocks because they're going up, have no understanding that, there's a real risk of bankruptcy in a lot of these companies. But the point here is this is also one of the things that you hear a lot from the media is that, interest rates have to go up, right? So we're going to get inflation and interest rates will have to go up because we get inflation. And in theory, that's correct. And if you take a look at the manufacturing data and the ISM data, it all suggests that we should see higher yields on bonds. The problem is, as soon as yields go up very much, you wind up popping, kind of this debt problem. Housing purchases stop, mortgage applications stop, credit card spending slows down. I mean, it's just, auto sales drop. Everything that's debt driven, as soon as that monthly payment goes up by not much, consumers go, either A, I can't afford it, or B, I'm just going to wait until that rate comes back down again, then I'll buy it.
Right. I mean, just look at the housing market. What's going to happen to the housing market if mortgage rates go to 4?
Right.
It's going to collapse. It's going to go back to what happened in 2008-9. And that's at 4% mortgages. Right. And that holds true for many parts of the economy. Who's going to fund the federal government when their interest rates go up? Right. The interest expense will soar. It's going to become a huge part of the budget. And then we're not going to be able to fund the things that we like funding, right? So it just ripples throughout the economy. And there's, a great graph we've shown a million times where yields for the last 30 years have come down, but it's not just a straight line down. It's a jagged line. And every time they get a little bit too far, if you think about it following a trend, every time they get a little too far above that trend, the economy breaks.
Right.
There's either a recession or some sort of financial banking crisis that occurs. And now we're at the point where, what do you think? Right now, the 10-year U.S. Treasury bond is like 0.80, 0.90,
right?
Less than 1%. I mean, I'd be surprised if it could get to 1.5 or 2%. without breaking something again.
Well, and we saw that back in 2018, right? Interest rates tried to pop up in January, February, March, and the market declined by 20%. The economy started slowing down. I mean, you just had a whole knockoff effect there very quick. And this really puts the Fed in a real problem, right? The Federal Reserve keeps talking about, when we get inflation, we're going to start raising interest rates. No, you're not. Every time you try to raise interest rates, you kill the economy. And so you're now forever stuck at zero. And which means that the only real stimulus you have for the economy is you can't lower rates anymore. So that's going to have to be some form of monetary intervention through either QE or, as we said earlier, direct stock purchases. But
that's really the end game, isn't it? Yeah. If we really truly get inflation, game's over, right? Yeah. If inflation really starts running 3, 4, 5%, and the Fed says we have to stop this, the game is over. Because how do you stop it? You do reverse QE, you raise interest rates, and the devastating effect that will have on both the markets and the economy is you can't even think about things like that right now.
Which is why they should be careful about doing more stimulus. They did stimulus back in March and April and May, and we did a lot of, direct checks to households, and we didn't really get much of an inflationary push out of it because there was such a big deflationary impact from what was going on with the pandemic. But if you try to do that now, all of a sudden, you could create a real strong, very short-term inflationary push because people are already consuming. They're back to work doing what they want to do. Now you're going to give them extra money. They're going to go out and consume extra stuff. It'll be a very short-term blip in inflation, very transitory. But the Fed will see that as, oh my gosh, we've got this inflation problem to deal with. So, very quickly it could back them into a corner of not being able to do anything.
Right.
So they need to be real careful about this.
Right. And let's think about that. What if the Fed does do nothing? What if they say, look, this is just a short-term blip, but it's not short. I mean, it is a short-term blip, but it just keeps going. Mm-hmm. And it people slowly become aware the Fed has no way to stop this thing. Right. And then inflation can feed on itself. People start worrying. They start buying things because they're worried that the price will be higher a week from now.
Yeah, toilet paper.
Right. Toilet paper. Exactly. It can feed on itself. And that is where it can become very problematic, and the Fed has no way to stop that. They have ways to stop it, but those ways we don't want to hear about because that will put an end to everything they've done for the last 30, 40 years.
Well, and look, and again, we need to step back from this for a moment and really kind of go back to the beginning of our conversation, which is, look, if you're invested in the markets and, we manage money for clients and, we just need to buy stuff that's going up. That's our job. That's one thing, but that's a very small percentage of the economy that we're talking about here. And it's, if you're listening to the show right now, it's because you have money invested. So congratulations, you're in the top 5-10% of the economy if you've got any significant amount of money invested at all, particularly outside of your 401k plan. But for the rest of the economy, this doesn't really matter. The stuff we're talking about here doesn't really matter. They're concerned about, their job. They're, paying their mortgage, paying their auto loans, and trying to get wage increases, and that's not happening, right? And that hasn't happened in a long time.
Right. And if you think about it, the Fed wants more inflation. The Fed wants you to pay more. At the same time, they're incenting companies to be less productive, meaning that companies can't pay you more to keep up with inflation because they're not as profitable if they're not as productive. So this is the trap that employees are in, that companies are in, that the economy is in, that we can't have the inflation that the Fed says they want. Absolutely. Because it will, from a social perspective, from an economic perspective, it will push everything into overdrive, what we've been seeing.
All right. Thanks, Mike. Appreciate it very much. Get by the website, realinvestmentadvice.com. Our Technically Speaking post is up right now. Investors are all in again at the website now. Technically Speaking post for today. Be sure to send us your questions, comments, and emails, and check out our subscriber service, riapro.net, realinvestmentadvice.com. You'll find everything there. We'll see you tomorrow in the next edition of The Real Investment Show.
It's a rich man's world.